This is the monetary policy statement for February 2012. After peaking in October 2011, inflationary pressures have continued to abate for the third successive month. Actual headline and core inflation declined 25.7% and 28.1% respectively in January 2012, from 27% and 29.2% in December 2011. Annual food inflation also fell 27.3% in January from 34.7% in December 2011. Monthly core inflation declined to 0% in January 2012 from 0.7% in December 2011. Hence, there was no increase in the average price of the goods and services in the core inflation basket during January 2012. Monthly food and food crops inflation have been negative in each of the last 3 months, an indication that the impact of supply-side shocks to food prices are now abating. Annual non-food inflation, however, increased 24.2% in January 2012 from 29% in December 2011, in part because of the increase in power tariffs. The rise in interest rates, which took place during the second half of 2011, has brought about a market deceleration in the growth of bank lending, which has been growing at a very fast rate, which had been growing at a very fast rate earlier in the year. This has helped to dampen demand-side pressures, especially on food inflation. Furthermore, the strengthening of the shilling against the US dollar since November 2011 will also help to ease pressures on the non-food inflation in the near term. Nonetheless, major upside risks to inflation remain, not least from Uganda's weak current account provision and the consequences that this may have for the exchange rate going forward. The Bank of Uganda is determined to bring down inflation sharply and stabilize it at around the policy target of 5% in the medium term. The increase in interest rates implemented by the Bank of Uganda since the middle of last year have already yielded positive results, as reflected in the strengthening of the exchange rate and a sharp decline in the growth of commercial bank credit, which has dampened inflationary pressures. The softening of domestic demand and the projected decline in global commodity prices, especially oil prices, are both likely to contribute to lower inflation in the period ahead. compared to the previous month, the Bank of Uganda now believes that the prospects for a fall in inflation during the course of 2012 have strengthened. The Bank of Uganda is now confident that inflation will be reduced to single-digit levels by the end of calendar 2012. This is because of the sharp fall in credit and monetary growth, the strengthening of the exchange rate, and the fall in commodity prices globally. Because of this, a very cautious easing of the monetary policy stance is now warranted. Accordingly, the Bank of Uganda will reduce the central bank rate from 23% to 22% in February 2012. From 23% to 22% in February 2012. The band on the CBR will remain plus or minus 3 percentage points, and the margin on the real discount rate will remain at 4 percentage points on the CBR. The real discount rate and the bank rate will therefore fall by 1 percentage point to 26 and 27% respectively.